Welcome to the Bet Out of That Show Sunday morning. I have Super P up in the building. We have a few of our faves in the chat, and it's a kind of overcast day here in Seattle. Patrick, we're going to talk about a couple of things today. The first thing you're going to talk about is what? It's moving averages.
We're going to talk about moving averages and how to interpret them and the various periods of moving averages, long-term, short-term, intermediate term.
Yeah, and we talk about moving averages quite a bit. Like every show, I talk about the exponential moving average and stocks staying above it. Patrick is going to go into the theory of moving averages and why it's important and some of the limitations. So you don't want to miss that. And then secondly, Patrick, what are we going to talk about after that?
We're going to talk about the benefits and opportunities of investing in Adobe.
Adobe.
Yes.
And you definitely don't want to miss that. That's the trade I've been killing Adobe, but we'll get into it. Let's start the show, Patrick.
Okay.
All right, Patrick, we're back from the intro. And before we get started into the moving averages, I want to show something on camera, Patrick, if I can.
Go for it.
I'm going to show this. Black Coffee Northwest. It's a coffee company out here in Seattle. They celebrated their 1-year anniversary yesterday, and I had the fortune of being out there, talking to the owner, and it's a husband and wife owner. And so I was out there, I picked up this hat, talked to them about coming on the show. So Erwin and Darnisha, Erwin is the husband, Darnisha obviously is the wife, and kind of going through Black Coffee and looking at some of the positive stuff they're doing. They're opening their second location down in Ballard and looking to expand in other states. And for those who live in Seattle, everyone knows Black Coffee people. They're on the news all the time. They're always on TV. There's reality show offers and all kinds of things that's going on. And they're a friend of the family and they're a friend of the show. And, Black businesses connecting, and we were talking about things. So I got a good chance to spend some time with them and their 1-year anniversary. So look forward to seeing the husband and wife of Black Coffee, the owners, and their story. Erwin was breaking it down yesterday. It was powerful. And I supposed to, we had Olympia on like a couple of weeks ago. And so I supposed to went over to see Olympia. She was having a fundraiser, a 5K. And man, my truck broke down and I wasn't able to go over there. I went and picked up the e-bikes from our e-bike shop in Lake Forest Park and I was going to drive over there. And I got the e-bikes in the truck, came back to the house, went to start the truck and it wouldn't start. So I have a broke down Navigator sitting in my driveway, but I was able to ride the e-bikes over to Black Coffee and see Darnisha and Erwin yesterday for the second half of the day. But we'll be sending some donations over to Olympia to support Project Girl. So that's another good cause. If you guys did not see the Project Girl interview with Olympia Edwards, go back a couple of days and check that out. Olympia is doing some powerful stuff, her and her husband. And so, and he's an engineer too, her husband, which is cool, me being an engineer. So I just wanted to throw those shouts out, Patrick, before we get into this
Yes.
business, if that's okay.
Yeah, absolutely. And yeah, please donate to Olympia's cause. And I think it would be very exciting to have the proprietors of Black Coffee on this show. That'd be a great show.
Yeah, some of my past thumbnails, I was wearing a black coffee hoodie. And when Erwin and Donisha comes on, I plan on putting this on my head and actually wearing it. I may even have my black coffee hoodie on. That'll be one show where I'll probably be representing black coffee to the fullest. But yeah, look them up online. They're big time. They're doing a lot of stuff for these for kids around here, minority kids, black kids. They're putting a studio in Black Coffee in the back portion. They have tutoring and mentorship programs similar to what Olympia does, and it's all free. Just like
Hmm.
Olympia stuff is all free. So it's just good stuff. All right, Patrick. So let's get into the show, Patrick. Today, you wanted to share some moving averages, the strengths, what is a moving average, and some of the limitations. So let's get into that.
Okay. So first of all, I just want to go to my screen, um, and I'll show this the most commonly used periods creating moving average lines. So let me share the screen right now. All right.
All right. Well, hopefully these screens will work today. Oh yeah, you popped up here. Let's see if it
Okay,
works here.
so this is an article in Investopedia, and these are the most commonly used periods in creating moving average lines. And moving averages are one of the most commonly used technical indicators in stocks, futures, and forex trading. Market analysis and traders use moving averages to help identify trends in price fluctuations, smoothing out the noise and short-lived spikes. From news to earnings announcements, for example, of individual stocks or indexes. There are different types of moving averages calculated in different ways and over different time periods, which reveal different information for traders. And the type of moving average and the measurement period that used to determine the strategies a trader implements. So, what are some of the common moving average periods? Um, I think for the identifying significant long-term support and resistance levels and overall trends, the 50, 100, and 200-day moving averages are common. And these are based on historical statistics. The longer term averages are considered more reliable trend indicators and less susceptible to temporary fluctuations in price. The 200-day moving average is considered especially significant in stock trading. As long as the 50-day moving average of a stock price remains above the 200-day moving average, and I'll get into the significance of that later in this discussion, the stock is generally thought to be in a bullish trend. A crossover to the downside of the 200-day moving average is interpreted to be bearish. Now, you could use various time periods to look to interpret, shorter or longer term trends. And here you would look at the period moving average or 5-day moving average, the 10-day, 20, or 50-day moving averages for those shorter term trends. And they could be used as cues for longer term trends. Crossovers of the 50-day moving average by either the 10 or 20-day moving average are regarded as significant. They may not necessarily be what one would call a death cross, and I'll get into that later, but they may indicate, short term, intermediate term trends, like especially if the shorter period moving averages go below the longer 50-day moving average. And there are various methods of using moving average. You could use Fibonacci numbers. Some traders use them. Some traders don't. And now, the types of moving average that exist are the you could use the intraday ones, and you could do the longer term trends, as I was discussing before. Um, the There are numerous variations of moving averages and they are calculated based on closing price, open price, high price, low price, or a calculation combining these various price levels. Most moving averages are some form of the simple moving average, which is the average price over a given time period, or you could use the exponential moving average, which is weighted to favor the more recent price action. Simple moving averages can be slow to catch up if large price swings occur. Traders often look at exponential moving averages instead, as they react quicker to price changes and therefore provide a more accurate reading. Time is of the essence of trading, obviously. So, an exponential moving average and double exponential moving average both reflect the current price trend for given securities in a more up-to-date reading. The drawback, though, is that because moving averages by nature are lagging indicators, meaning that they're more backwards looking than forwards looking, getting the readings up to speed is important. The exponential gives more weight to the most recent prices, thereby aligning the average closer to the current prices. And as I was saying, the unfortunate thing of moving averages is that they tend to be, again, backwards looking, both the simple moving averages and the exponential moving averages.
Good stuff.
So what I'll talk about right now are the golden cross and death cross definitions. So let me share the screen here.
Yeah, Patrick. Before we go to the death cross and the golden cross, it was
Yes.
interesting what you showed. There was a 26. There was something talking about more of a shorter term trend with the 26, because
Yes.
from my training, the big averages. There's the short term average, which not really that short, which is the 50-day moving average. That's what everyone uses. So if you're on CNBC, you watch that. They use typically the 50-day moving average as a short term trend to see if you're in a bullish short term trajectory for a stock. And then everyone uses the 200-day moving average for long-term trajectory. So if you're looking at a 3-year, 5-year chart, long-term is the stock on an uptrend or bullish trajectory. But you had some other ones in there. I saw a 26 and some trends less than 50-day for a short term.
Exactly. And it depends upon your time frame. of investing. Like if you're trying to catch really, really short term trends, then you might use maybe a 2 or 3 day or 5 day. Or if you're doing an intraday chart, you might use like a 2 minute or 2 period, 2 minute day, a 2 minute moving average, 5 minute moving average, 10 minute moving average. Depends upon, I mean, you could tweak these moving averages and their time periods to suit your trading needs. But the most common ones are the 200-day moving averages for the long term trends, the 50-day moving average for short to intermediate term, and the 9 or 10 day moving averages for the shorter term. Those are the most common ones.
Yeah, and that 20-day, we talk about the 20-day with the Bollinger Band quite a bit and how stocks typically want to trade along that monthly period as well.
Hmm.
But I guess the main thing is 200-day, 50-day, 20-day, I would say, and then
Yes.
everything else. If you want to go shorter time frames, I mean, depending on your trading strategy, then you can go shorter. But most of us, the point I'm trying to make is we'll stay around the 50-day and a 200-day. Most of us will
Yes.
use the 50-day as our short term trading, and our long term would be the 200-day. That's kind of the point I wanted to make. Maybe I'm being a little long winded about it, but that's really the point I wanted to make. The 50 and 200 days are the most common moving averages. I really like one thing you showed too, and that was the difference between the simple moving average and the exponential. Because people ask, why are you using the exponential moving average? And so what you just showed explained that.
Yes. Because the simple moving day moving averages, to reiterate, it doesn't take into effect a lot of the outliers that have happened in the past. Whereas the exponential moving averages kind of tweaks it more to the more relevant current information that's out there.
Yeah. The exponential is more near term skewed,
Hmm.
where the simple just uses everything, and you could have all of these crazy anomalies from the past, where the
Hmm.
exponential flattens that out. So yeah, but okay,
As well as the exponential moving average is probably somewhat better for forward looking or more current price trends.
right.
And unfortunately, even with the exponential moving average, as I was saying before, the it tends to be a backwards looking indicator,
Yeah.
and you might just use it for confirmation of a
Well,
trend.
all of these moving averages are backwards looking right here.
Yes.
So we're talking technical analysis backwards looking. We have forward looking technical analysis too. That's a different show.
Yes.
But these are very popular ways to predict. These are very popular ways to predict the future of a company by
Hmm.
looking at the past. And so
Right.
that's the whole purpose here. If you can predict what's going to happen in the future, then you can make a lot of money, either on the upside or downside. So that's really the
Exactly.
goal behind all of these moving averages. Look at the past, and based on the past, predict what's going to happen in the future. So, all right, Patrick, let's get into this golden cross and this death cross, these indicators of what you call the crossover, meaning a change of direction in the stock, because that's super important. If you're going to invest in the market or even trade, then you need to know when a stock is going up to now it's going to go down, or going
Yes.
from falling to now it's going to go up. So you can make a lot of money either way if you could predict that direction. And now you're going to go over a prediction strategy. So let's hear that, Patrick.
Okay. So first of all, I'm going to share my screen and talk about a golden cross. And here is another excellent article from Investopedia, and we're going to pretty much talk about what is a golden cross. And to begin with, a golden cross is a chart pattern which a relatively short-term moving average crosses above a long-term moving average. The golden cross is a bullish breakout formed from a crossover involving a security's short-term moving average, such as a 15-day moving average breaking above its long-term moving average, such as a 50-day moving average or resistance level. Long-term indicators carry much more weight. So the typical discussion or typical definition of a golden cross in indicating when a bull market is on the horizon usually involves the 50-day moving average going above the 200-day moving average, as seen right here. So here you have this this security as it was trending, as it starts to trend higher, and then as the uptrend is better established, you can see that the 50-day moving average is crossing over the 200-day moving average, confirming that uptrend. So here, that confirmation here of the upwards crossover is what one would call a golden cross.
And that is a super bullish trend, that golden cross. That golden cross, once you see that, you can, if you are betting, if you're a betting person, investing person, then that is a good investment that the stock is going to continue to go up in share price. And so then one could double down, triple down on the price of a stock to say, hey, I have a lot of upside potential profit to make. So that's a really bullish sign, a golden cross, when that 50 is below and crosses over the 200 day. Very bullish.
Yes, yes. And conversely, a death cross is where you have a 50-day moving average crossing from above, going below the 200-day moving average. And then I'll share that screen. So a death cross is a technical chart pattern indicating the potential for a major sell-off. And this is a very, very bearish sentiment when the 50-day moving average goes below the 200-day moving average. And there have been 4 dates that have really indicated bearish death crosses, including the 1929 stock market crash that brought on the Great Depression. Around 1938, when the Second World War started, was getting into full effect. The 1974 Arab oil embargo and the stagflation of the 1970s, and of course 2008, where you had the housing market and financial market firestorm that brought on the Great Recession, which was almost a depression. And graphically, this is what it looks like. So here,
can you blow that up a little bit, Patrick, please? Maybe you can't.
Yes.
On that web page. I'm not sure. Maybe
yeah, I
you
might
can't.
not
I
be
don't
able
want
to.
Go ahead. I don't want to interrupt you.
Yeah, okay. How about this? This looks a
Okay.
little bit better.
Sure.
And then, maybe I'll just
Yeah, that's better.
zoom out. Okay, so here, this is the S&P 500 chart. This is around 2018. And then here you have a 50-day moving average. You've had this volatile downward action, which continued for a period of time. And then the 200-day moving average was violated by the 50-day moving average going to the downside. And as you can see, that's quite the sell-off from 2920 to 2600. That's about a 10% correction.
Yeah, and you can see on this chart here, if you're looking here, you can see how the S&P 500 is just sells off. Can you go up to the top where it begins to sell off there, Patrick?
Yeah,
Yeah,
right
right
there.
there. So it's beginning. Can you circle a bit just so that for illustration purposes? Oh man, super. Yeah, right there. Yes. So you can see in the S&P 500 is tracking the largest 500 companies in the U.S. stock market, right? So
Yes.
one would plot the 200-day moving average for the S&P, plot the 50-day moving average for the S&P, and look at the price per share to buy the S&P 500, right? And so as you
Mm-hmm.
look at that price action, those moving average, those trend lines will move as well. And so you can see over to the right where the short-term 50-day moving average based on the price action of the S&P 500, the trend line crosses over the 200-day. That
Yes, it
is
does.
that is very bad. When
That is
the top 500 stocks, the companies sell off like that, that's a real bearish sign that the market is going to continue to go down, and not go down for weeks, but for a long period of time, for months. So that is a very bearish sign. So I guess the point here is not only should you be charting 50-day and 200-day moving averages for an individual stock, but you should be charting 50-day and 200-day moving averages for the S&P 500 as a whole. That is the point. So,
exactly.
yeah. So, Patrick, I'm out of there if you can stop sharing.
Yeah, and that's what I've done.
Yeah, so I mean that's kind of is was that kind of it what we were going to talk about as far as moving averages and explaining what a moving average is?
Well, what I want to do is show that stocks that keep above the 200-day moving average
Okay,
tend to be
but
very,
Patrick, before you go there, I want to nitpick a little bit. Can I nitpick a little bit?
yes, yeah.
All right. This is in pre-productions. This is what I told you to be prepared for. So Patrick is seeing this for the first time because we like to have a live reaction on camera. So Patrick, back on September the 6th, about 5 weeks ago, maybe
Hmm.
6 weeks ago, we had a show. We did a show on DocuSign. Do you remember that?
I do. I do.
And during that show on DocuSign had reported earnings. You were really, really big on DocuSign. And I was big on DocuSign, provided that DocuSign sell off. DocuSign was selling on September the 6th at $310 a share.
Yes, it
And
was.
I had some concerns about DocuSign. And I said, DocuSign, maybe you should not buy DocuSign. Maybe you should buy Adobe. Can I refresh
Hmm.
your memory, show some old footage from that?
Go for it.
All right, let me start out where we initially started to talk about DocuSign on September the 6th. I'm going to share this. The video is a little grainy, but let me see if I can share it.
Hmm.
Everything is not beautiful with DocuSign from my perspective, but certainly long term, man, if you're going to be a long term investor and just sprinkle some money in there, and be prepared for a fall to get more, be prepared for the stock price to fall and get more, then yeah, I'm more DocuSign for that. But I do see some challenges ahead for DocuSign. But let's do the first litmus test. So Patrick, that was the initial You were super bullish on DocuSign. I was like, the PE ratio is too expensive for DocuSign. You should be buying Adobe.
Mm-hmm.
Adobe's the stock. Can I show you what I said about Adobe back then?
Yes.
All right. Let me show you this clip of what I said about Adobe on September the 6th on the Bet Out of That show. This is DocuSign. I have DocuSign up, Patrick.
Yes.
And I'm looking at Yahoo Finance in particular. And you can see that DocuSign has, done well over the last few days here. One thing, a concern that I have, a couple of concerns. One is the forward PE. So the price to earnings, and we talk about this all the time. The price of a stock is essentially what the company earns per share, the EPS. And then the forward PE is called the multiple, or the trailing PE. The PE is called the multiple. That's how many times you're willing to pay above what the company earns. The forward PE on DocuSign is 185, currently 192 times earnings. And I did the sound effects earlier when you were showing the other charts. I will not do it again. But that's big in this environment, in this inflationary, deflationary environment. When inflation kicks in, when if the economy starts to kind of freak out on inflationary concerns, this high multiple over the EPS, this company is going to be at risk. That's one headwind. Now let's look at Adobe in comparison, because Adobe doesn't do exactly, but Adobe has a similar product where you can do signing and documents, and it's a pretty established company. Adobe forward PE, based on the EPS is projected to earn, is only 43, Patrick. So its forward PE, based on its recent earnings, is 43 times what the company earns, where DocuSign is 185. So again, a lot of what you were saying, there's a lot of bullish sentiment around this company, but if the economy starts to slide, if people start getting concerned about inflation, guess who's not going to slide that much? Because it's only 43 times the earnings. Adobe is going to hang in there. Adobe may go down to 40 times earnings, the price of the stock, maybe 30 times earnings, the price of the stock. And so it's not going to get hit percentage as hard as a DocuSign, where you are paying 192 times earnings. So for this to come down to less than 100 times earnings, this price of this stock is really going to get hit. Now, long term, do I believe it's a good buy? Absolutely. But I think there may be an opportunity for this stock to pull back. It would be cheaper. Maybe you can get this stock at 100 times earnings or 75 times earnings versus buying it at 192 times earnings. All right, Patrick. Now, Patrick, guess what DocuSign is times the EPS now?
And what is it?
About 102 times EPS. So DocuSign did exactly what was predicted in that episode. DocuSign, that earnings, that PE was way too high, and DocuSign had reported you were super bullish, I was super bullish long term, meaning short term, you got to wait for it to pull in, and it's pulling in a bit. Let me show you one additional thing from that episode, and then let's move in. Let me show you something else I said on September the 6th, okay?
Yeah.
All right. So then let me go over to Adobe. So here's Adobe. I'm gonna show you what a solid company looks like, and it's unfair because Adobe's been out for a while, right? This other company
Yes.
is still getting its footing. Profitability. Look at this. Let's blow this up. Profitability 38%. Operating margins 35%. Return on equity 13%. 15 is spectacular and better. They're doing 13%. But look at return. Well, that was return on assets. Look at return on equity 45%. So that's what I'm talking about. When you had an opportunity to invest in a company like this in this environment, that's where you gotta go, my friend. So, for me, just looking at all of that other stuff, Patrick, and all of the hoopla and celebrating and year over year, but you're not looking at the debt. You're not looking at return on assets negative, return on equity negative. The PE ratio is 192 times what it earns. Price to book is big. And we're in an inflationary environment where when inflation concerns, everyone goes for the cheaper stocks. They go for stocks that are solid, that's not priced so heavily with a high PE ratio. So, yeah. Yeah.
Um,
And in this environment
yeah, of
where
course.
there are inflationary concerns, whether true or not, but just concerns, why play around? Let's see DocuSign earnings bake out was cheaper, less kind of mill through the inflationary concerns, right?
Yes.
And in this environment, if you got money, like you're making monthly income, you should be putting away at least 15% of your money every month, paying
Right.
yourself first, investing before you spend anything.
Yes.
So that monthly, if you're gonna put that money to work, put it to work in something like Adobe in this environment, and a little bit into DocuSign. But
Exactly.
but when that pullback happens, we know what we'll be doing. We'll be doing a show on DocuSign. Yours truly will be buying DocuSign on the next stock crash. It's incredible
Okay.
company. So,
And I would agree with you 100%.
all right, Patrick. So that was from September the 6th.
Mm-hmm.
The market has gone down.
Yes.
DocuSign has pulled back from 310. It's down $50 a share. That's big. 310 to 260 right now. And we're not talking DocuSign. We're talking Adobe.
But let me do a chart comparison, if I'm well, before I get into Adobe, of how both companies have fared over the year to date. If I may share this screen.
Okay.
So I'll share the screen right here.
Hold on. Let me get right for you to share the screen.
Okay, are you ready?
And then I want to go into a trade. I want to actually go into a trade that can make some money.
Absolutely. But let me
Okay.
share this quick screen
Yeah.
momentarily.
All
So
right.
right now, yes, or DocuSign has come down from 310 to about 260. But if you look at the year to date, Adobe definitely has better performed DocuSign because Adobe is um, the trend in the light blue, and DocuSign is the trend in the dark blue. Adobe has returned year to date a respectable 21.47% year to date. Now, give me 1 second. Let me do full screen and give me 1 second. Yeah. All right. What I was about to show you is that the 21% was for Adobe, and DocuSign is still up 17% year to date.
Okay, yeah. I'm not saying DocuSign is not down, but from September the 6th, we said if DocuSign pulled back, we would be talking DocuSign. We're talking Adobe.
Yes,
But
yes,
there's a good reason why we're talking Adobe.
there is a good reason. And
DocuSign is down, but 6 weeks later, and looking at the fundamentals, DocuSign, Zach's further downgraded DocuSign and put a sell on it. There are some serious headwinds with the EPS growth of DocuSign. They're continually beating earnings, but they're beating it with a smaller margin. Adobe is killing it more. So why take a chance? I'm going to have to retract on my words back in September, first week in September. I'm not doing the Adobe trade. The DocuSign trade. I will be doing the Adobe trade, just like what you're talking about today. So rather than go through,
exactly.
let's just go into Adobe. Let's talk about Adobe. Let's share why Adobe is what we are telling our audience to buy. And then let's share the trade on what we could do to make some money.
Okay, so first of all, I just want to go over the key statistics of Adobe. I mean, DocuSign is still not bad, but I always said do not bet the farm on DocuSign.
You did say that. And you also said scale in slowly too. So
Yes, exactly. And let me see. Stock profile. Here we go. So right now we're looking at a price to earnings. That's a trailing price to earnings, which is always higher than the forward PE of 59.15%.
can you blow that up a bit, Patrick?
Yes. How's that?
That's better.
Okay. Then we have the forward PE of 47, 48%. The PEG ratio is still a respectable 3% or three times PEG ratio. Return on equity, 35%, which is very, very strong. Return on assets is 19 points, close to 20%. The profit margin is close to 41%. The net profit margin is 23.78%. And the debt to equity ratio is a very strong 0.3%. So the financial fundamentals are very strong. As you know, Adobe is, just to give a little background as to why it's such a great company. Adobe Incorporated is one of the largest software companies in the world. It's a company that offers a line of products and services used by creative professionals, marketers, knowledge workers, application developers, enterprises, and consumers for creating, managing, and delivering, measuring, optimizing, and engaging with compelling content and experiences across personal computers, devices, and media. It's a company that markets and license its products and services directly to enterprise customers through their sales force and end users through app stores and their own website at www.adobe.com. They offer many of their products via software as a service, or SaaS for short, model, or managed service model, as well as through term subscription and pay per use models. They also distribute certain products and services through a network of distributors, value added resellers, system integrators, independent software developers, retailers, software developers, and original equipment manufacturers. So they have and they're also in the Nasdaq 100, the S&P 100, which are the top 100 companies on the S&P, the S&P 500. So it's being well represented across many important indices. And those are some of the strong fundamentals of Adobe. Now,
Okay.
was
Let me do something really quick here, Patrick. Okay. So you we're in agreement on a Adobe here now.
yes, um,
We always
I
have been.
we always have been,
Yeah, we
but
always have been.
but at the
But
time when I did that previous podcast, I thought, okay, well, DocuSign looks interesting. You might want to throw a little bit of money there. Again, don't bet the farm on it.
right. And again, this environment is inflationary. You
It is.
cannot. You have to look at the PE ratio, and that's
Hmm.
really the point I was trying to make for our audience. That they have to associate the PE ratio with they have to associate the PE ratio with the price of the stock. You have to just look at that PE ratio in this inflationary environment. And when I
Hmm.
look at a DocuSign, which has an incredible growth potential and incredible moat, that PE, the price, that stock is too expensive. You're paying way too many times at the time for that stock. Now, the PE is around 100, 102 versus 194 if you
And,
were to go
and
look at it.
and that's still a little pricey.
That's still a little pricey. It's
That's still a
still a
little
little
pricey.
pricey in this
However,
environment because, again, when interest rates are high, stocks would die. When interest rates are low, stocks would grow. So that means these when the interest rates are low, even these high PE ratio companies will grow. But when the interest rates are high, only the low PE ratios will grow, right? So when the interest rate, that's just the old saying, when the interest rates are low, stocks will grow. When the interest rates are high, stocks would die. I learned that back in the early 90s. And so, yeah, I mean, that's the point. So, Patrick, was that it on Adobe? Was that all you had on
uh,
Adobe? I thought you had some more
no,
fundamental analysis on Adobe.
I did. I did.
And before we go
And
into the trade, because I want to make some people some money. So let's talk
yes.
more about the fundamentals and why Adobe is such a great investable company, please.
Okay, so I'll get into this here. Share this article on CNBC.com. Give me one moment. Okay, are you seeing it? The make it.
Yeah, let me slap her up there. Super. You're up there. Tony, I see your comment. I'm going to flash it on the screen in a moment. I'm trying to get myself back on the screen with Patrick. All right, go ahead, Patrick.
All right, are we ready to go? Great. So, according to this article here in CNBC, these 10 companies have the happiest employees. Here's why. And there's the Adobe sign I'm looking at right here. That's the logo there. Adobe was named the number one company with the happiest employees in 2021, according to a new report from the company review site Comparability. The annual ranking considers 70,000 U.S. companies and identifies where workers are the most satisfied with aspects related to their work environment, pay, benefits, and the company goals. Here are the top 10 large companies with 500 or more people who have the happiest employers of the year. And number one is Adobe. Look at that in San Jose. Number two, Ring Central. I mean, you could go through this article and have Peloton's up there too.
Oh,
Microsoft is up there.
Microsoft got happy people.
Yes, the
Really?
new CEO. Yeah, the new CEO is a visionary. He's
Yeah,
really turned
Nadella.
that company around.
Yeah,
Yes,
Nadella
I
is
mean
much better than Balmer.
he took over Steve Ballmer, and one thing I'm very happy to say is that I'm there's a product that's especially near and dear to my heart, which is Microsoft Flight Simulator. I like to pretend that I'm a pilot sometimes, um, but it got revived and it got re-engineered under this new CEO, and it's a much better product than it's ever been. So, anyways, that's Microsoft. IBM is also in there, and Zoom videos
Interesting.
communications. So those are some of the company that Adobe keeps.
Yeah, I see one Seattle company in there. I do not see some of the other Seattle companies like Amazon, Boeing, T-Mobile, Zillow, Nordstrom's, to name a few.
All right. But these rankings are based on anonymous employee ratings on topics that contribute to the overall happiness at work, which are submitted to comparability over a 12-month period from September 2020 to September 2021. And these are some of the questions below. Is your work environment positive or negative? Do you believe you are paid fairly? Are you satisfied with your benefits? Do you feel burnt out at work? Are your company goals clear? And are you invested in them? Are you typically excited about going to work each day, which is critical? I mean, are you looking forward to Monday morning, or are you dreading Sunday night? Do you look forward to interacting with your coworkers? Are you proud to be part of your company? On a scale of 1 to 10, how likely are you likely to recommend this company to a friend? And Adobe's number one ranking dethrones Zoom 2 year run of having the happiest employees in 2009 and 2010. And the video conferencing company fell to ninth place this year. But comparability CEO tells CNBC the different scores among the top 10 companies are negligible and are based on tens of thousands of data points. He likens it to a scoring from 99 on a test of out of a 100. So again, these are the top companies to work for. What stands out about Adobe's reviews, Netflix says, is the positive feedback from multiple departments, including product, marketing, design, sales, and engineering employees who rate the company highly across factors that indicate a rewarding culture and supportive environment. Gloria Chan, Adobe's chief people officer, says the company measured employee sentiment throughout the pandemic through surveys, company all hands meetings, and focus groups to better understand the challenges of working through COVID and propose solutions to meet changing needs. In response to the feedback, the company introduced monthly company-wide days off, 20 new paid days off each year for employees directly impacted by significant events like pandemics or natural disasters, flexible work schedules to accommodate caregiving responsibilities, and an increase of its wellness reimbursement to $600 per year. The company has prioritized building community and staying connected while apart, Chen says, such as through a bi-weekly coffee break series and its annual diversity inclusion event. We're fortunate to have genuine employees who are invested in our culture and community, and many of our best initiatives that are driven by employees themselves, Chen says. After the risk of the pandemic subside, the default work arrangement for all employees will be flexible, Chen goes on, meaning Adobe employees will have the option to work from home when it makes sense for them, their team, and the business. She says employees co-created Adobe's future work model through a series of global surveys, focus groups, workshops, and working sessions. Currently, some Adobe offices are open at limited capacity with employees back in person on a voluntary basis.
Nice. Nice, Patrick. Very nice.
So you have very, very happy employees, the happiest in the working world. And when uh, the employees are happy, they're going to produce
Oh, yeah.
much strong and provide much stronger than results than those that do not have happy
So,
employees.
now, Patrick, I have a question in the chat and as a matter of fact, since Adobe is such a good company, maybe I should reach out to my niece, Ashley Johnson, and ask her to work for Adobe, since Adobe is such a good company. I think my niece has a mechanical engineering degree, but I would think that all of these companies could use mechanical as well as electrical. But Tony Johnson has a question here. I think it's a good question, and I think we should address it before we get into a trade. And that is, how does Adobe look? How does Adobe look with Bollinger Bands? Does it look like a buy? It doesn't look like a buy to me. So he's looking at the Bollinger Bands and saying, Adobe doesn't look like a buy based on its recent price action. Can we look at Adobe? Because
Yes.
let's talk about a trade on Adobe. And so can we look at the Bollinger Bands there? Would you
Yeah.
like for me to pull the Bollinger Band on Adobe?
I could get that.
You can? All right,
Um,
let's do it.
yeah. So, first of all,
And then let's talk a trade. Because there's
yes.
a couple of interesting things with Adobe. So if you go to bar chart, I want to show you, and then I want to show you the trade that I'm looking at. And I want to make some quick, easy money here,
hmm
Patrick.
Okay. So,
Let me
first of
hold
all,
on for a second, Patrick. I'm in the way here on the screen, and I can't move myself for whatever reason. Something's happening. Let me see if I can. Wow, I'm in the way and I'm not able to move myself here. So I'm blocking the screen. Maybe yeah, I want go ahead, Patrick. I'm gonna try to I can move you over, but for some reason I can't move myself. But let me just remove myself from the screen as you talk, and then we can get going. So go ahead, Patrick.
okay. So the screen that I'm sharing right now is the Adobe chart over a 5 year period. And right now, to establish is Adobe a good company or has it been a good company, you can see that the chart from roughly November 2016 has constantly stayed way above the 200-day moving average. And that 200-day moving average is upward sloping.
That's that red line, right?
The red line is the 200-day moving
Right,
average.
and it's going to 383. That's the
Yes,
200-day moving average. It's way at today's price above 383.
which is, and today's price is
So
about,
Adobe is a huge long-term growth. So if Adobe dips, that means just buy it because it's going to go back up based on its past. That's what that means. Now continue, please.
okay, now to address the concerns of the Bollinger Bands. So what I'll do
Let's go
is,
short term. All right, Patrick, let's go short term. Let's go a 6 month. a 6-month chart daily and look at the Bollinger Bands there to look at a trade.
Okay, first of all, before I get into the Bollinger Band, got to get through these ads here. Again, here's the 200-day moving average.
What
Upward
period are we
trending.
looking at? Are we looking at 1 year, 6 months? What are we looking at?
We're looking at a 6-month chart.
Okay.
So
6
that's
month
roughly
daily.
daily chart from around April 15th till right now, October 15th, which is the last trading day.
Okay.
So as you can see, again, it's never dipped below the 200-day moving average on a short-term basis. It's touched it with the recent sell-off, but it's always held constant. And here you've had a couple of bearish crossovers. No death crosses here, but just some crossovers, like the shorter term and intermediate term, like the 9-day, and this is the 20-day moving average in gold, dipped below the 50. But right now, that's because Adobe has broken out of this area here. I'm just going to circle that. It seems to be on its way higher, and the 3 moving averages seem to be converging right here, as you can see. The
God
distance
dang it.
between them.
Super P, God dang it. Will you get to the Bollinger Band? That's the question.
Yeah, well, I just wanted to make a point here that it looks like it's going higher. However,
Yeah,
let's
you
go
got
to
so
the
many indicators up there. Let's keep it simple, Patrick. Please. Get to the
yeah
Bollinger Band, please, sir.
yeah. We'll get there. We'll get
Yeah,
there.
yeah. All
We'll
right.
get there.
Enough playing with my friend Patrick. Go ahead, Patrick. All right. So let's remove some of those. Let's get and just go. Let's use exponential. Oh, let's use the Bollinger Band. We'll go simple. And let me move you over a little more. And you did use. All right. So we got the simple Bollinger Bands. We do not have all of that other jazz up there. All
hmm
right. Oh, I see what Tony is talking about here now. Oh, look how big that Bollinger Band is, Patrick.
Yes.
Okay. So Patrick, can we, are you okay with zero in? Well, I think that's good enough. We can see that. All right, Patrick. Where's the trade here? So look at this. Now, typically on a chart like this, you have Adobe. The trade really was a week or so ago. If you go down to the beginning of October, where the bottom of the
Yeah.
Bollinger Band, Adobe was, right there, there we go.
Yeah.
Like the beginning of October, I actually sold a put right there at the beginning of October at 500. And I collected, let's say, thousands of dollars before I get myself in some trouble here and have people knocking at my door saying, can you give me a loan? But I saw Adobe right here at the beginning of October. So I sold a put, and I sold it for multiple thousands of dollars and collected that money right on the spot. And the reason why I did that, Patrick, go back up on the Bollinger Band. Look how big look how wide the Bollinger Band is. And Patrick, can you pull that? Can you blow that out a bit? Make that. Can you go out some? You have this. Yeah. Thank you. So if you look how
Yep.
wide the Bollinger Band is from the top of the band to the bottom, that shows that the premium price on an option is really big. And so with that
hmm
large premium price, you could really make tens of thousands of dollars selling puts there. So I went out and I sold some at the 500 level, knowing that Adobe is a growth stock, which Patrick just showed you. It consistently stays above the exponential 200-day moving average. So selling a put at around 500, I doubt it would get down there. by the beginning of the year. So I sold a put down there and made a lot of money. But that's why I sold versus bought, because that Bollinger Band is so wide, which represents a very high premium that you can collect for selling options. Now, with that said, Patrick, with that said, how would you trade today on Adobe? What trade would you do? I'll show you what trade I would do and the trade I'm planning to do. So which way you want to go? You want to go with what you would do or what I would do, based on us being as bullish as we are on Adobe?
Yes. Well, what I would do is I would just buy little bits and pieces. Don't buy it all at once. And because, if I were to go back to the 6-month chart, here it did a breakout.
You
So
need to
it did
share
this.
again, Patrick.
Oh, sorry.
So let's put on the trade. I'm gonna show you the trade that I would like to do, and that I'm probably gonna do in the next week or so.
Okay.
And then I want to show something else on bar chart for our audience to consider. Okay?
Okay, so right here, as I was discussing, the the moving averages are coming together, the shorter ones, and right here you've had a breakout at 585, and then it's rocketed up as high as 610 because the market, of course, has been very strong as of late. And then what I would do is maybe just buy bits and pieces of it right now. You might get a pullback, and that's to address the concern that maybe it's a little bit too high, it's a little bit too far from the bottom Bollinger Band. So again, don't buy all at once. That's the trade that I would do. Just buy little bits and pieces for a longer period of time.
Gotcha. Hold on, Super. I think I got you up here twice. I think I got you up here twice. Good gracious. I'm having some technical difficulties here. All right, Patrick. So, here's the trade. Let's go back, please.
Okay. So I'll show the screen again.
Yeah, please.
All right, no problem.
Or maybe I could just do my own screen, Patrick.
Yeah, I might not be able to see it though.
Oh, yeah. You want, God, Patrick, we're going to have to get you a second monitor, my friend. And yeah, let's get here. Okay. So let's go to the Bollinger Bands, please.
Okay, so let me get rid of these.
And you can always hit me directly if you want even more details. We're going to have to say some of these details just to save on time. Bollinger Band. Yep. Here we go. All right. So we have the Bollinger Band here. We have a pretty wide band. Here's a couple of things that I see. Let's go 3-month chart, please, Patrick.
3-month chart. Okay.
All right. So, let's make that smaller so the bands will fit. So maybe squeeze it a little bit. And make sure it fits on the screen. Yeah, I'm in the way. I'm talking, but okay, that's good enough. So, look how wide the bands are. If you look at the 646 on the top band, I think that's 646. And then in the middle band, 594.
Yes.
And then the bottom band is 542.
Yes.
Obviously, option prices are still very elevated.
Yes.
You cannot buy a call with the band this wide. You just there's too much volatility baked into the premium of the option. So what I would look is for this top band and this bottom band to come more together. Once they come together more, which shows the volatility is a lot less and the option premiums a lot less, then I would buy at the money call based on this catalyst. Now let's go over, Patrick, to the left. I'm sorry. And can you click on to the left? Can you click? Can you click on price overview, please?
Yeah, price overview.
Yes. So on price overview, look at move the screen up a little bit, my friend, and move it up and below the chart there so I can show you the next earning reporting date. And look, stop right there. Next earnings report date. Can you circle that, Patrick?
Yeah, right here. The
12/9.
Yes.
So on 12/9,
December 9th.
December 9th, Adobe is going to report again. And so the reason why the band was so wide before, because the market sold off in late September and early October. We predicted that on this show. For those who follow, September is a traditional bad month. September is really known as a bad month. So we knew the market's going to sell off. When the market sells off, a lot of puts out there, volatility goes crazy, the option prices go up, the wide band. But as the market starts to go up into the Santa Claus rally, which happens November and December, the Bollinger Bands should contract, option prices should come down, and when they contract, being the Bollinger Band, you should buy, or what I'm going to buy, at the money call on Adobe on a play for this earnings call on December the 9th. Now, how far would I go out on this expiration on this? Me personally, I will go out 2 earnings. So that means I will go out to June. So I'm going to buy at the money call once the Bollinger Bands come in on a June call, at the money on the long strike, and I'm going to do a short strike probably at 80% out of the money. If that sounds way too complicated, hit me. Just hit me with betoutofdebt.com. Then my email is there. You just hit me with YouTube. I can give you more details, or call me for those who know me. But that's going to be an easy trade. You already looked at the 200-day moving average. It's consistently above. Earnings, all of the companies are beating earnings. So Adobe, in the position it is in, should beat earnings. But the real litmus test is going to be when Microsoft and all of those guys report, not next week, but the following week. If they're beating earnings, all of the tech companies in 2 weeks, if they're all beating earnings, then Adobe should be on track to beat earnings too in December. And you want to start buying about 6 weeks before earnings. And so if you buy a call 6 weeks before earnings, which I'm letting you know now, once those Bollinger Bands come together, which they should come together within about a week, then that's a trade, dude. That's the trade right there that can make you tens of thousands of dollars in a short period of time, depending on how much risk you take. So that's my trade, Patrick, there on Adobe.
Okay.
Did that make sense, Patrick?
Follow that. It does.
Yeah, buy at the money. At the money call. Buy at the money call. June expiration. Short 80% probability out the money. June expiration. And when the trade is up 100%, close the trade. And the trade should be up 100% probably in December, maybe June. So whatever you put up, You know, if you put up 5 G's and you up another 5 G's, close the trade and don't try to get the 10 G's or the 15 G's. Just when you're up 75% to 100%, just close the
Kill
trade
it.
and walk away with the money. That
Agreed.
is almost, it's just a super defined trade. And we showed you everything to make that trade. Now, do you understand all of the option terminology? No, but you can go to YouTube and learn all of that stuff. Buying a call at the money. And basically what I'm talking about is a debit spread. So if anyone were to go to YouTube and search what is a debit spread, what's a call spread, a bull call spread, a bull debit spread, that's exactly what I just described. A at the money bull debit spread. And so that's it. That's an easy 10 G's. If things work out the way I just described. And none of us can predict the future, but I feel pretty confident on that one. And Patrick, we'll do a future show on that one. Once this one goes down, once I do that trade, once I make my profits on that one. And so we need to do a future show on that one.
Exactly.
Yep. So what do you think of that trade, Patrick?
I think it's a good call.
Well, if you think it's a good call, are you going to do? Are you potentially going to do that trade?
I'll do something similar.
Ooh, do tell.
I'll probably do something like that. So I'll just kind of watch it for now, though.
Yeah, the Bollinger Bands, like what Tony was saying, will have to come in a bit, the top and the bottom band, so it's not so wide. And Adobe needs to be at least at the middle of the Bollinger Band and not on the top line of the Bollinger Band. So Adobe needs to come down to at least a 20-day moving average at the middle. But if it comes there to the middle and those Bollinger Bands come in, I'm definitely going to do a at the money call June 15th expiration. I think it's the 15th, 16th. June expiration. $80 short probability out of the money. And I'm going to put up some G's because I feel pretty confident that that's just easy money. And I'm going to probably put up some big G's. So, yeah. But we'll see how the trade goes.
Gotcha.
All right, Patrick. So I think that's all we had for today on that. Let's wrap it up, Patrick, unless you have something else.
No, that's great. Adobe's a great company, as you can see. And, just as I said, if you're going to buy the stock itself, buy a little bit here, wait for a pullback, buy some more. Always dollar cost average.
Okay. Well, words to live by. So that is the Bet Out of Debt show. And for today, we call it the Bet Out of Debt show because when you place a trade, it's really called, placing a bet. And hopefully it's a winner one to keep you out of debt. And as always, keep investing. And we will see you next week on the Bet Out of Debt show. And leave us a comment. If you learned something, like the video. If you learned something, hit the notification bell so that you'll be notified when we are live. And just keep sharing your comments. It always makes us better and it improves upon the content that we decide to share with you. So we will see you next week. Take care, guys.